In the world of trading, there are millions of indicators, overcomplicated charts, and overall confusion. So in today's video, I'm going to use my 7 years experience as a full-time trader to boil down just the essentials of technical analysis. Okay, so I'm going to cover things like how to properly read a chart, how to accurately spot trends, the simple indicators that I use, the essential terminology that pro traders use, and at the end, we're going to tie all of these concepts together, and I'm going to show you one of the best simple trading strategies that you can start trading today to launch your trading career. And if that sounds good, make sure you hit the like button on the video, subscribe to the channel if you're new and you like trading and investing. Check us out on TikTok, Instagram, Discord. We have an incredible trading community. So I think one of the most important things for any person getting into trading is understanding what a chart is actually representing and how do we accurately read it. So what we have to remember is, even though this looks like a bunch of lines on a graph, what this is showing us is an aggregation of mass human psychology and people buying and selling. So when we're looking at individual movements on this graph, this is indicating decisions that real traders and algorithms are making and representing to us on the chart. So there are ways that we can read this, there are ways that we can quantify this and put ourselves in a position where we can start to make money looking at these patterns. All right, and there's all different ways of representing price movement. The most commonly used way of showing price action on a chart is something called candlesticks. Okay, and that's exactly what we see here. If you have trading experience, you probably know what candlesticks are, but basically all this is showing us over a certain period of time, also known as a chart frequency, what the high, low, open, and close range were. So if you remember, if you've ever learned about box and whisker plots, every time we see a candle, we have our upper extreme, which is the high of that increment of time. We have our upper and lower quartiles, we have our median level, and then we have our low extreme. So basically all of the movement that happened in price is going to be represented by one candle showing 4 hours of price movement. The color is going to show whether the candle closed at a net gain or a net loss. The orange candles for me are going to signal that this was a net loss over time, and the white hollow candles are showing a net gain. No matter what color the candle is, this wick is always going to be the high price and this wick is going to be the low price. Same thing with this candle. This is the low price and this is the high price. The reason this is orange is because the price opened here. This is going to show you the open and this is going to show you where the price closed. Okay, so once again, price on this candle opened here and closed here with the highs and lows. So we can basically go down to any time frame and look at how much the price has moved during that period of time and start to look to set up patterns and make money on this using other indicators. All right, and this price movement is oftentimes referred to as price action. So anytime you hear the word price action, it's simply talking about the price movement in that specific time period or section that we're looking at. Okay, if you have some trading experience, this is going to seem pretty basic to you, but as we go further, I'm going to get more and more advanced on the topics that we're talking about, and I'm going to show you a system using all of these things we've learned to be able to crush tops and bottoms in the market and be able to snipe some nice profits the way myself and my community members are doing. And so the next topic that I want to cover regarding price action in reading charts is supply and demand. Now, there's a reason why these candles are having certain areas where it's moving down and certain areas where it's moving up. And that's because there's people on both sides of this market simultaneously fighting, buying and selling. So there's constantly units passing hands back and forth, and that's going to cause the price to either go up if there's more demand than supply. And if there's more supply in the market and less demand, the price is going to move down to find the range to see where the next price discovery range is going to be. Okay, when I say the term price discovery, we can see areas like this where we have something called consolidation. Consolidation simply means that the price is starting to find a nice tight range that it's trading in, and then when it breaks out of that range, it's discovering a new price range. So you're going to see a lot more volatility before it starts to settle. So this is the discovery phase right here, and then this is the consolidation. Okay, but let's get a little bit more into detail about supply and demand. So the way we can visually look at supply and demand levels is by using trend lines. So we're going to basically go in, if you're on TradingView, you can go in here and you can use the trend line tool. Okay, and all we want to do is start looking at important points of the price action where the price seems to be reacting and then reversing. Okay, so instantly I'm looking at this as sort of a standout point here, as well as this upper region here and this lower region down here. So what I can do is I can draw a line from this low region over to here and this low region over to here. The interesting part is that if we were to clone this level right here and move this up to this high region where we started to see the supply win, okay, if we notice, we see in this region of price discovery, the price broke out, came back down, sort of sat on top of this level, and then continued to move up. So what we can do is start looking at these levels visually to come up with trade ideas and see where the market is likely to reverse. So once again, I can sort of identify this invisible wall on this trend level here. So if I click along these lows, we can see the price continues to hit off of this level and catch what's called support. Support is when the price can't break down through a certain level and it keeps holding the price up. On the other side of the coin, when the price can't break up through a level and it's underneath the level, that's going to be called resistance, because it's resisting the price breaking up, and then support, it's holding the price up on the other side. Let's say we have our trend here where we have price held up here, price being held up here, here, here. We get a big move up, and then this price breaks down and finally breaks through that level, meaning that the sellers are beating the buyers and the supply is outweighing the demand. Notice how when the price comes back up and tests this trend again, no longer is it support and now it's turning into resistance before we get a move down in the price. Okay, so we can start to use this strategy to say, okay, if we had an uptrend moving here, price breaks down and it retests that level, this could be an area where the price is going to move down, and we can start constructing a thesis to decide where the market could flip, and that's going to allow us to make money once we have a system behind this concept. The next indicator that I want to talk about that I think every trader should be aware of are moving averages. Okay, so we have simple moving averages and exponential moving averages. So I'm going to show you on the chart how to use these and what we typically look at and sort of what institutions look at with moving averages. Okay, so I'm going to use a simple example here. Basically, we have two types of moving averages. Well, actually, there's three, but we're going to focus on the major two, which are simple moving averages and exponential moving averages. All right, so the differences between these two things is the sensitivity to the most recent price action. So with a simple moving average, say we're taking the candles in here, what it's going to do is it's going to take an average of all of these prices, and if with a simple moving average, it's going to distribute the average over all of these candles and plot a line of movement that is going to follow the trend. And depending on the period of the moving average is going to show you how many calculations are being made on this. And the lower the period, the closer this line is going to be to the actual movement of the trend. So this would be a shorter period SMA, and this would be a longer period SMA. So basically, simple moving averages are going to show you the general direction of a trend. Okay, right here, this is an exponential moving average. So the way exponential moving averages work is instead of finding an even calculation of the average price of all these candles, the way we had our simple moving average like this, the EMA is now weighing the most recent price action exponentially more than the beginning of the period. Say if we're calculating over these amount of candles, the closer that the candles get to the current price, which tends to make the moving average line a lot more sensitive to the most recent price action. So if this is going to be our simple moving average, if we were to get a big move in price, something like this, okay, the simple moving average would sort of trail behind the price like this and eventually catch up, whereas the EMA, okay, would probably cross over this simple moving average because it's more reactive to the most recent price action. And this is why we can use SMA EMA crosses. Oftentimes we use those in indicators like MACD, which is moving average, convergent, divergent. I'm not going to get into that indicator today, but basically what we can also do is look at different periods, different sensitivity EMAs to figure out when we're going to get a macro change in trend. So right here on this indicator that we use for a system on our premium side called the TCL system, okay, we're using a 20, a 50, and a 200-day EMA. All right, so if we go down to say a 5-minute time frame, we can see as the 20 and the 50 cross, they're going to turn green, and then as the 20 and the 50 crosses the 200-day, okay, all of these are going to turn green, which is going to indicate that the average price of this trend is trending up, and that's going to signify an uptrend. We can see when we have aggressive moves down, the most sensitive exponential moving average is going to come first and cross through the 50-day and the 200-day, which are taking the average of more candles, which is why they're slower to react. So when we have these shorter term EMAs crossing through the longer term EMAs, it can indicate a temporary change in trend and can oftentimes give us signals that a trend is beginning and we can take a trade opportunity off of that indication. Okay, moving averages are very complicated, but I want to show you something that is very simple that you can start using on your investing that also institutional money is going to look at, and this will sort of allow you to start at least using them a little bit in your own trading. Okay, a lot of institutional money and big investors use something called a 200-day moving average. This is a simple moving average over a 200-day period. They can show you the general strength and health of an investment vehicle. So let's take a look at Ethereum on a 1-day chart, meaning that each candle is showing us 1 day's worth of price action. So we can see this is sort of riding along this uptrend. And then right here in 2022, we see Ethereum break under the 200-day SMA, come up, retest it again, and has been trading underneath it until as of recently in February of 2023, where we broke above it and we're now catching support. So this is usually called the death cross. When we have strong investments that are trading on top of the 200-day EMA, okay, this is considered strong. Once we break that and we're underneath it, it is a bearish indication for the vehicle until we see it break to the upside. So this could be a really good sign for crypto and for Ethereum in general that we've tested it and now we're continuing to move higher. But that's a way that you could start using moving averages, conceptualize a little bit more about how you're going to use them. All right, the next indicator that I'm going to talk about is probably my favorite and what I believe to be the most important indicator to know in trading that has led to me making the most amount of money and having the clearest view of when markets are going to change directions and how to get into trades. And that's going to be Fibonacci. Okay, so Fibonacci can be a little bit complicated to understand, but I'm going to try to show you with a little bit of science and a little bit of implementation on the chart how to truly understand Fibonacci and how amazingly beautiful it is, why it works, and how we can use it to make money. All right, so if you remember in the beginning how I was explaining that movement on the chart is just people buying and selling and making collective decisions, which is representing mass human psychology. Okay, we can use naturally occurring ratios to be able to predict where markets are going to move, how they're going to retrace or extend, and where people are going to make specific decisions based on people's natural human intuition, whether they realize they're doing it or not. Okay, but before we get into Fibonacci, I want to show you the indicator and then show you how and why it actually works. So if we go over into our toolbox over here, we can see Fibonacci retracement, and we have a trend-based fib extension. These are my two favorite trading tools possibly on the earth. So I'm going to show you how these sort of work. So this is what your Fibonacci tool is going to look like, and you're going to see that you have a 0 level, a 1 level, and then you have 78.6, 61.8, which is the most important number to know in the Fibonacci sequence. You have 50, 38.2, and 23.6. Now, what do these numbers represent? Why is it important? Why is it on the chart? What are we even looking at? Okay, so something that we need to understand about Fibonacci is that this is a ratio that occurs in nature, and for some reason, it's basically like the code of the universe. The way plants grow, the way your face is constructed, the way cells work. This is all following the same ratio. Okay, we've seen the pyramids were built using the Fibonacci ratio. Okay, anytime you're looking at the way trees grow or the way leaves grow, anything in nature is going to follow this same ratio, which we can then start to apply to the chart. Okay, so basically this ratio goes as the following. This is a mathematical series beginning with 1 and 1. The next number is formed from the sum of the previous two numbers. So if we start off with 1, the next number is going to be the sum of those two, which is going to give us 2. All right, so we can see in this sequence, we're going to start out with 0, and then we're going to have 0, 1. The sum of those two numbers is 1. Then we have the sum of these two numbers, which is going to be 2. We have the sum of these two numbers, which is going to be 3. Okay, we have the sum of these two numbers, which is going to be 5, 8, 13, 21, etc. So if we look at things in nature like seashells, or if we look at something like a plant, we're going to start out with 1 stem. Okay, that's going to branch out into 2 stems, which is going to have 1 stem breaking out into 2 and the other stem continuing to grow, which is going to give us 3, 5, 8, 13, etc. So this is exactly why when we're looking at our indicator over here, we're gonna have our 0 level, our 23.6, 38.2, 0.5, 61.8, and 78.6, and then we have our 1s. These are going to be our critical levels. But the reason why the 61.8 level is considered the golden ratio in Fibonacci is because if you divide any of the Fibonacci sequence with the following number, it's going to approach the ratio of 0.618. So if we're looking at a move in the market, say we're looking at something like this, where we have the price moves down and then comes back up to this level right here. Watch what happens if I click from this high point, right, down to this low point. See exactly where the price came to before having a massive reversal. And also notice how the price action is catching resistance here at these significant levels on the fib. Now, if we tie this in with other technical analysis, this is where all of these tools start to become extremely powerful, okay? So say, for example, we find our supply and demand level. So if we look at this low this low, this high. Our next resistance area is going to be right in this level. And then once again, if we take a Fibonacci from this point down to here, which is going to be our major move, this price came right into our golden ratio before continuing to move down. So if we wanted to take a position on something like this, we could open up a position here that if it breaks through this ratio, we're going to get out. But if it continues to move down, we're going to make 4.41x what we're risking on the trade. So now you're starting to see how all of these things are going to come together. So you can start to look at the way charts move and use all these tools. Okay, but it gets even better because my next favorite tool is called the trend-based fib extension. Okay, this is such a cool instrument because now what we're doing is we're taking this golden ratio and we're taking multiples off of initial market move and we're looking at projected levels by multiplying that one level by 161.8. So we can see over here, if we have an initial move here, say off of the beginning of a trend, okay, the 161.8 is oftentimes going to be the top of the trend. So we can use projection levels to anticipate the tops of trends. Let's identify a couple different trends here. So we have an uptrend here, price breaks it, now is moving in a downtrend. Okay, so what we can do is we can look at our initial move here where we have the beginning of the trend to where we kind of get our first little turnaround point and then a continuation. If I click on my tool and I click on that level here, down into this level here, and then back up to the beginning of that trend. So basically this part right here is going to correspond to this part on this diagram we see over here. Okay, look at where our 261.8 projection is showing us the bottom of this trend. We also have support levels off of this 161.8. So we can use other technical analysis to figure out whether or not the price is going to turn around at this level, but that these Fibonacci projections are showing us where trends are reversing. Okay, let's look at another example. So we have our downtrend here where we're getting resistance, resistance, resistance. Price breaks it, catches support, and then continues moving up. So now we have a new uptrend right here. Watch what happens if we use our same projection tool. If we take our trend-based fib extension off of this beginning here up to this high level back down, okay, we can see a perfect response off of this level, and the price basically perfectly comes up to our 161.8 the way we see on this diagram here, but it gets even better than this. So once we have our top projected on this trend, we can use our Fibonacci retracement tool off of this projected top here to the low point on the trend where this price action breaks this uptrend. We can start from this high once we get a rejection and a confirmation off of the 161.8, and we can draw a Fibonacci down to this most recent low before we get a push up and look exactly where the price action came into with the 61.8 before reversing like crazy. If you're able to identify an uptrend where we have the top running into this 161.8 level, okay, we can wait for the price to come down and break this temporary uptrend before coming back up, retesting the 61.8, and then crashing down. So if you want to position yourself at this level, put your stop loss over this 5 wave here, and then put your take profit down here. This is basically the concept behind a trading system called the 358. This is what we trade on our premium Discord with our community. There's a video that I'll put in a card right here that you can watch after this video that will show you how to take all the steps to set this up. But basically you can use all of these tools to be able to figure out major reversals in the market and take positions. And so say for example, I wanted to take a position off of here, okay, and I'm waiting for the price to come up into this region. I can go over into an exchange and barely use any of my own money to be able to take a position on this and make money when we're right about predicting the direction that the coin is going to go. So we can go into Femex over here, which is the exchange that we use to leverage trade in our community. We can trade a ton of coins. We have really high leverage, which means we don't have to use a lot of our money and we're able to accurately trade these markets. Great. So I can go over into Femex. I can go up to contracts here, and then I can decide how much leverage I want to use on this position. Okay, I have other videos showing how to position size, how to use leverage, everything. But what I'm just going to show you is how I can get into this position right here. So I can click over here. I can put in my 1920 entry. So I'll do my entry level, which is 1920 minus my stop loss level, the level I'm going to sell if I'm wrong. So I'll subtract those two. That's going to give me this. I'm going to copy this quantity, and then I'm going to put the dollar amount that I want to risk on the trade. So if I want to risk $1,000, I'm going to divide that by that, and that's going to give me how many units I need to enter the trade with. So 73 Ethereum is what I need for this trade. So you can see the cost of that position without leverage is going to be $140,000. Okay, I only have about 20,000 in my trading account. So you can see, even though I need 73 ETH, if I turn my leverage up to say 50, now you can see the cost of this position to risk $1,000 to hopefully make $4,500, so $4,500 on this trade. it's only going to cost me $2,900 to actually get into this position. Okay, so I can set everything up. I can decide my leverage amount. Then I'll check this box here. I'll put my take profit, which is going to be down here. Stop loss over this high level here, which is going to be 1933, and I'll submit the short order. But basically, once I set that limit, the price will come up, fill that limit, and then hopefully everything working well, it comes down and gets us out for full profit. Okay, and we're able to make $4,500 on a trade. Okay, that would be a really good 358 trade. And that's the whole concept behind how we're able to use technical analysis to be able to enter positions, get in the market at strategic moments, put the odds in our favor to be able to make bank. Okay, guys, there's so much noise out there. There's so many different indicators, things to focus on. I've been doing this for nearly 7 years. I just wanted to show you the boiled down basics of what I look at on charts and how I'm able to basically just use what information's given to me to be able to take trades accurately, concisely, and without too much noise. Okay, if you're still here with me and you feel like you learned something cool, let me know in the comments which part or which thing you felt was the coolest or the most helpful. I would love to hear some feedback from you guys to make sure that I'm doing the right things and showing you some cool stuff. Share this video with your friends if you feel like you guys can use it to make money together. And since you're still here, make sure you hit the like button if you liked this video, subscribe to the channel if you want to hang out with us and learn more about trading, and make sure you check out the Discord if you want to get a little bit more involved in the type of trading that we're doing. But anyways, guys, I hope this video helped. I will see you all in the next video.